Hey guys, Toby Mathis, and I've been asked to answer the following question. What's the difference between a write off and a tax deduction? You ready? There is no difference, right? The tax write off and the tax deduction are really the same thing. I think the confusion really comes down to the difference between a tax credit and a deduction. So a write off, a lot of times people are thinking about like, hey, I'm going to go to meal. It's just a write off. It still costs me money, but I'll be able to offset at least a portion of my income by that money that I'm spending. So like let's say I spend $100 on a meal, and this year, let's say I do it in a restaurant, I might get to write off 100%. Previous years it might have been 50%. I would subtract that amount against my income. So let's say I made $100 and I spent $100. In theory, I'd pay zero. But what if I put that meal on a credit card? I still get the deduction, even though I haven't paid my credit card yet. And that's how you have a lot of people that end up creating what's called like a tax loss, or, hey, I don't have taxable income, yet I still have money in my account and things like that. A lot of folks actually incorrectly assume that your taxes on how much cash is actually left in your account at the end of the year. And they'll go out and invest in things. Same concept. If I do it on a meal and I put it on a credit, I get an immediate deduction, even though I haven't paid for the credit card yet. If I buy certain items, like a car, for example, and I paid cash, I don't get to write it all off. I don't get a full deduction. I have to push it out over a period of years unless it qualifies as equipment or something like that under Section 179. I have limitations. For example, if it's a nice luxury car or something, then I have a maximum amount right around $16,000 a year that I can write off. So if I spent $100,000 on a car and I bought it with cash, I might only get a corresponding deduction of 16 grand or thereabouts. So all of a sudden I'm saying, but wait a second, I don't have any money. How could I owe tax on something, even if I use it 100% for my business? How could I owe tax on that? And that's when you start looking at how taxes actually flow. Is though even though I put a dollar in and it came out of my account, doesn't mean I get a dollar deduction. Just because no money went out of my account and I bought something on credit doesn't mean I get no deduction. I could end up with a massive loss. Like that's why people invest in real estate, is because quite often they're doing it on leverage. Quite often they're going to get a large amount in those first few years if they accelerate the depreciation doing a cost seg or something like that. They're going to get this massive tax loss during those years. And the question is, can they use it all? Right? Sometimes it's not wise to go to zero. Now, let me address the real issue, which is what I see as the difference between deductions and tax credits. So a deduction just offsets the income. So again, I make $100,000 and I have $30,000 of deduction. I spent $30,000, right? But now I'm only going to have to pay tax on $70,000 at the end of the day. That's my net. So my net profit. So let's say I'm a sole proprietor. I'm going to owe employment taxes on that. I'm going to owe federal income taxes on that and state income taxes. So a tax credit works like this. Let's say I did the same thing. I spent $30,000, but that $30,000 awarded me a tax credit dollar for dollar. So let's just say that I spent money and I get this massive tax credit. And I'm not saying that you're going to get that on everything. There's some things out there where you get some tax credits. But let's just say that I'm just use this as an example. So I have a $30,000 tax credit. I don't get a deduction. So I would still have $100,000 of income. And let's say that after all, I add up all my tax bill ends up being $30,000. I would use the $30,000 I spent as a credit against my $30,000. So they offset. So it's not subtracted against the $100,000. It's subtracted against the tax liability. So put it another way. Again, let's say that I $100,000 and I had a deduction of $30,000. That means my taxable income is $70,000, right? So then I would calculate my tax. So let's say that my tax, I'm just going to use 20%. I'm just going to use a flat tax, even though it doesn't exist. But let's just say that your taxes are 20%. That means you owe $14,000. So you're going to send that in. Let's just say that's federal taxes. So that's a deduction. So that's our little deduction. Now let's say it's a $30,000 tax credit. So let's say the same situation. I make $100,000, but I have a tax credit. I don't actually have a deduction. So let's just say that I'm going to pay 14% on 100,000, or 20%, excuse me. I use 20 over here. I'm going to use 20 over here. So I owe $20,000, but I have a tax credit of 30,000. That means I'm going to have, if it's a refundable tax credit, I would actually get back $10,000. So I would end up with a loss that gets refunded to me. Like, there's certain tax credits that are refundable tax credits. Like we saw the child tax credit where everybody's getting paid ahead of time and they get money. Or refundable tax credit means that if I use up offsets all my taxes, then they're going to send me the difference. But now I have this nice situation where I don't owe any taxes. So the question to you then is, which is better? It's pretty obvious, right? The tax credits are better. What types of things give businesses tax credit? There's a lot of things right now in alternative energies, things like that, big ones in solar. You can go into those areas where you're able to generate a tax credit, even if I finance. So for example, I put solar up on a rental property, I could get a 26% tax credit, plus I can still get a tax deduction on a portion of it as well. It ends up being 87% because the way the rules are, I get half of the credit amount subtracted off of the basis. That's going to give me the amount that I can deduct. So I'm going to get a tax credit in that scenario, a nice tax credit. Let's say that I did $100,000 unit up on top of a property, and I financed it. I'm going to get a tax credit for $26,000, plus I'm going to get an $87,000 tax deduction. And that's where the magic really occurs. Once you start realizing those two things and that they're completely different, then it starts changing the way that you invest. You start looking for things saying, hey, wait a second, I have positive income coming through all the time. I'm always getting hit with the tax stick. And you start looking for things like that. Hey, are there any tax credits rolling around? Are there energy credits? Are there anything I can get a tax credit? I need a tax credit. Hey, you got a tax credit over there? Like, I'm looking around for those things, and then I'm looking for deductions. Hey, is there any way I can get a deduction if I'm buying big equipment? Is there any way I can accelerate it? Is there any way I can take it now? Hey, if I buy real estate, hey, I know you said 27 and a half years or 39 years on the depreciation, but hey, can I get some of that right now? Yeah, do a cost like, let's get 30% this year immediately. Oh, okay, yeah, I need that, right? That's what tax planning really gets exciting, is when you start looking at it going, wait a second, these deductions can be really tasty. When coupled with credits, it can be absolutely potent, and you start looking for these things. So again, I know the question was, what's the difference between a write-off and a deduction? And there really isn't one, but what it really should go down to is, hey, can I get deductions, and is there something better? Can I get write-offs, and is there something better? And the answer is yes. Hey, if you like this type of information, please share it. If you're willing to, please subscribe and like this video. It helps us out, and it makes YouTube like us too.